Zahava, and welcome everyone. As Zahava mentioned, my name is Michael Wu. I'm a partner here in the corporate securities group at Winston and Strawn, and we work with a lot of entrepreneurs and early stage companies, as well as some of the managers or funds, I guess, that deploy capital to those types of companies. So with that, I think I'm just going to have each one of the panelists talk a little bit about themselves and why they're here.
Well, I already had the microphone, so I think you've already heard about us. But we work with other partners, including my friend on the right here. And so we co-invest with other partners as well as on our own. But we try to network with other like-minded investors. And again, early stage seed fund.
Thanks. Good to see you. My name is Haroun. I'm at a firm called Artis Ventures here in the Bay Area. We typically do Series B and onwards. We focus on all technology sectors. In terms of a couple of deals we've done in the past, one is we led the B round on YouTube. We're also investors in Bracket Computing, LookSharp, StemCentrics, and a number of other healthcare tech companies. Thanks.
Hi there, good afternoon. My name is Gail Gannon, and I represent an organization called Ask the Angels Network, and that's a consortium of thousands of investors. They can actually individually invest or invest as a group. We invest in early stage, all sectors, but my specialty is actually in the healthcare, from Internet of Things to the life sciences.
Hi there, my name's Sam. I work with SK Telecom Ventures, which is the dedicated venture arm of SK Telecom, which is a huge South Korean company. They produce 4% of South Korea's GDP, so if that gives you a size of the company, that's it. In terms of my investments, I look at core tech companies, anything with differentiated technology, with defensible IP. So, thanks.
As soon as they're done, there's a lady who has the 1 minute pitch, I promise. Who has to come in as soon as they're done with your 1 minute.
Okay, my name is Fernandez, and we actually do a combination of investment banking and venture capital with a specific narrow approach. We essentially invest in early stage companies by preparing them for IPO in secondary markets. So it's kind of an acceleration package for the company, and we execute the IPO, again, in secondary markets in a controlled environment. That's primarily what we do. That's at one level. There is another level in which we work, which is essentially identifying startups that may have technology elements that may make them eligible for the process I mentioned, and for that, mentoring at Singularity and Berkeley as well.
Good afternoon, my name is Michael Gurevich. I'm with a company that's called US Business Consulting and Investments. We also wear two hats. One is business consulting and back office operations, such as accounting and finance and business development. And we also have a small micro VC fund that co-invests with other partners. And our area is Internet of Things, robotics. We're in mainly B2G and B2B areas. Thank you.
Okay, great. So let's continue on with the panel discussion. I think the way I'd like to start off is talking a little bit about 2016. We're coming towards the end of the first quarter, and so maybe I can have the panelists talk about some of the trends or opportunities that they've seen so far in 2016.
You know, I did share that with everyone, I think, in my talk, but I'm seeing a cautiousness across the board. And in fact, I think that cautiousness really starts from seed all the way through the series, you know, A and B and C. We're beginning to see signals of some down rounds that are already occurring, and we're getting that across the stage. But I'm not seeing any lack of activity at the very early stage. It seems to still be a fairly robust funding climate. I think the caution has moved down from the public markets all the way down to the price rounds. I do think that also this is not necessarily an inopportune time to start a company, because in a market like this, it's actually an opportunity to show what you have, and if you can get traction earlier than later, I think it'll be more impressive to investors.
That's great. Thanks, George.
I agree. The funding environment seems to be slowing down a little bit right now. You know, over the past couple of years, it was really capital chasing entrepreneurs, and now it's certainly entrepreneurs chasing capital. I've received a number of follow-up calls or follow-up emails, people that have emailed me 4 or 5 times in the past couple of weeks saying, did you see this message, did you see it? So I can sense that there's a little bit more cautiousness from a fundraising perspective out there. It's still business as usual for us though. We look very long-term with all of our investments. In terms of trends that we're seeing that we tend to like right now, we always love platform solutions. So if you own the roads, you can charge the cars, be a tollkeeper, so to speak. So we're looking for platform solutions in the next generation platform, be it VR, but more likely the voice sector. I have an Amazon Echo at home. I think it's the most disruptive product I've seen since the iPad was released. So I'm looking for anything voice-based. I love ed tech as well, and another sector that we're very much invested in is IoT. We invested in an IoT platform company called Stringify recently, but we're looking for next generation IoT companies that will benefit from this trend. Thank you.
I would concur with both of you. I think one of the things that I have seen most recently is that there is somewhat of a land grab among some of the larger corporations looking for earlier stage technology so that they can actually co-develop or partner in earlier. And the opportunities that because of some of this waning of pipeline. One of the things that I noticed, because I come from the more healthcare side of things, is the Internet of Things and bringing value. So talking about owning the road is looking for a much more complete solution. So if you're the two-legged stool, you need to look for that third leg really early.
So I think this is the year where you'll see a lot more investments in VR. Investors, looking out 10 years, VR is not here right now. There's not mass consumer adoption, but in order to preempt that consumer adoption, there's going to be a lot of VC investment in that space this year. Whether that's gesture sensing, 3D cameras, or I wouldn't say 3D platforms themselves, but any of the vertical markets that could provide services or products or other components in the VR market, all of that will be really, really hot this year.
So on the topic of status or fundraising, seeding rounds for startups, and again, back to the sentiment that this year seems to be the adjusting year for valuations in particular, and maybe you are familiar with a post from, I think 3 weeks ago from Y Combinator about the advice for new startups in terms of what would be the valuation you need to think of for your seeding round. I think it was very explicit in a way because it has set up the tone for everyone in terms of expectations. So we are actually using that as a reference for the candidates out of Singularity, where I am mentoring these days. And we are looking to 4 to 6 million valuation, and this is what we recommend to start the dialogue with the investors rather than thinking about crazy numbers. And with that, really be very thoughtful in how to position your company, and maybe even bootstrapping yourself a little bit longer so that you get the right elements to pitch out your company maybe in a later on in a better condition. So I believe that all of that is already happening, and it's happening at different levels, and there is all over the media references to down rounds and what is happening with unicorns, but beyond that, at the startup level, I think the seeding round is now what is becoming also a process that is coming into more scrutiny and more due diligence. So I would say that the longer you can bootstrap and getting those traction points that will be relevant to articulate the proposition and the projections of your startup moving forward, the better in terms of negotiating with venture capitalists.
Thank you. I tend to agree with the panel members in terms of raising money at the earliest stage, that it's really important, at least for our limited partners, to understand what kind of revenue the company is potentially going to do, and what kind of traction the company is already doing, and also how they're actually going to be using the money from the funds that they raise. We pretty much still do business as usual as also the panel members stated. But again, it's becoming real critical to be able to explain the LPs why we're investing in the company that just started.
Great, thank you. So just to follow up on some of the points that the panelists raised, so assuming you've got a company that has approached you, and it's a company that you would invest in, how does that company stand out compared to some of its peers out there? Is there something that you guys look for in particular or don't want to see in particular that you can talk about?
I think it's a relentless determination is the thing that it's hard to judge, but you try to get that, and it's the irony or the interesting part about that in the companies now that we've been with for a couple of years or 18 months is that they're not afraid to test, they're not afraid to admit when they haven't been successful, and they're not afraid of changing and pivoting. So we had one company that had done what they said they do, which is go after the middle market in a marketing tech play. Were successful, but got a dialogue with the founder, and he called me and he said, we're going to take everything that we've done and we're going to change and focus on the Fortune 50. And I shared that story with everyone, but that's another example of founders that are determined but are willing to be coachable and willing to make a decision that's a difficult one, particularly when they're having success. The other thing is that they've done a good job of lining up co-investors, and I would encourage you that the quality of your investors early on will be a key factor to your success.
That's great. Thanks, George. So for me personally, I always believe that ideas are commodities, but execution is not. I'm always a big better on the jockey and a little bit less so the horse. And so we love to back investors that have had very successful exits in the past. Now, in the public markets, there's a notion of past performance is not indicative of future performance, but I believe it is in the private markets. If you've been very successful in the past and sold a company or started a company and had a fantastic exit, then the probability that you'll do well going forward is much, much higher. And so for me, it's always been about backing great management teams. Question here, yes?
Do you have data to back up your assumption?
Data, so for example, we own
No, but I mean that someone who's successful in the past is more successful in the future.
Yeah, absolutely.
Okay.
Yeah, I'll give you an example. Thank you for that. So we own 25% of a company called Data Domain, which was purchased by EMC. And the management team, we've backed them before. We invested them again in ServiceNow. And then we also invested them again as they founded a company called Nimble Storage, which went public a couple of years ago. And in the Valley, probably the poster child of this theme is PayPal, right? So we all talk about the PayPal mafia. And out of PayPal came Tesla, SpaceX, YouTube, which we invested in, Yelp, and there's many, many more. And so, and even with guys like Andy Bechtolsheim, who was the first employee at Sun Microsystems, he's never failed in all of his subsequent, startups. And so if you come back a great management team that's had, great success in the past, again, the probability of being successful going forward is much higher. That doesn't mean that we don't back management teams that have not started a company before. We do occasionally. But in that case, you might look at a guy like Mark Zuckerberg, for example, right? He had no experience before, but he surrounded himself with people like Peter Thiel, right? And many others that were his advisors that had a lot of success in the past. And so the bottom line for us always is the jockey is more important than the horse. Thank you.
I concur. So if you're new at the management and you're founders but you're passionate, is get other people who have had other experiences who can advise you in that particular vertical. Along with other things that we consider on the angel investment side, is to look at not only the market size but the market trajectory, and have you understand where your technology or product fits in the value chain. You really know it intimately. So more importantly, is in order to do that, you have to constantly talk to your customers, and your customers change over time too. So continue to talk to your customers. As founders, every founder should be out there talking to their customers. So you're talking to yourself, and what you think that your value of the product is, very much different from how they use the product or how they realize the product or what they price the product to be. And then the third and most important thing, and I mentioned it earlier, and I can't emphasize that enough, is that if you don't understand certain parts of your vertical, but you have a passion for it, is partner up. There are people who are looking for your technology out there. Learn from them. Watch their business models, and watch how they pivot in their business models too. You learn a lot from that as well.
So I like to see customer traction whenever I make an investment, and I know some of you probably have seed stage companies right now. I do more Series A, B, and so forth. But you know, we're lazy. Investors are lazy. So any sort of proof points that you could provide me, whether it's customer attraction or you know, you were on Shark Tank, things like that, it makes it easier. So I'm an associate, and you know, my role is to source deals, but I have to also re-pitch your deal to the partners so that it can move forward. So, you know, if you give me those little nuggets that I can just, you know, 1, 2, 3 3 points to the partner, it makes my life a lot easier, and it makes, you know, your chances of moving through my pipeline a lot better. So,
Sorry.
go ahead.
If you have items on a chair, can you take them off, because we have a lot of people coming now, we need all the seats. So can you please remove all the items on chairs, and raise your hand if there's an empty chair. There's empty chairs around here, feel free to take a seat, everybody who just came. Thank you. There's two over here. Can we take the items off that? There's a chair right here. We're gonna bring in more chairs here. There's a chair, raise your hand if you have an empty seat. There's over here, please. Thank you.
Okay, I think every day more and more we are, it depends on the size of the company obviously, but we see at the startup level more and more we look for the founder's trap, early signs of the founder's trap. If you're familiar with the concept, it will resonate with the things that have been said. Essentially the founder's trap is the inability of the founder's team, to deliver on the needs of the company once the company has grown. So typically founders at some point of time will feel that will not feel compelled to delegate or be able to partner with others in order to let his company grow, and they will remain there. We call that the founder's trap. It's a typical event that years ago was happening when companies were more mature. Now we are seeing that even at the early stages in startup companies. So we try to look for that on founders, like all those signs that when they are too much protective of their ideas, their way of managing the company, and in essence, if they are not able to partner up with others or to open themselves to advisors or other external elements and customers primarily as well, so that they can grow the company beyond themselves in a way. That's becoming like more and more important in making the assessment of the founder's dream.
Thanks. There are lots of different factors that we look at, and you know, team is being just one of them. We also look at whatever intellectual property the startups have, the obviously the traction, financial model, but one, and I guess one of the most important things that we look at is the experience of the founders, and if they don't really have much experience, their ability to be able to attract and hire and sustain people who are perhaps smarter than them and have that experience. Thanks.
So I wanted to touch upon some of the other topics that have been brought up. I think Gail, you mentioned partnering strategically with, you know, sort of a venture arm of a technology company. I think you could probably speak to that as well. But what are your views on that? I mean, is it a positive, negative? Is it something that people should think about exclusive to raising financing separately? And then, you know, if you don't have an opinion on that, maybe an opinion on crowdfunding.
I think that, you know, crowdfunding is possible at the very early angel stage, just that's my bias. But I think partnering is a function of the DNA of a deal. Having done a fair number of those in my past, I've done them correctly and and I've made some real mistakes. And I can tell you that the one determinant is how much skin, regardless of the size of the company, you're willing to put in spite of your size and your early stage. And oftentimes I had partnerships that worked because the partner was willing to invest either ahead of the revenue curve or dedicate resources. And the biggest challenge for the founders is to make the ask. And I mean, you need to ask because you need to come from that position of strength. And that's the hardest thing to do when you're early. So I'm a bias towards partnerships, but I've seen them work equally bad when there's no skin in the game from the other side.
That's great, thanks. So we partner a lot with large strategic technology venture firms. And so in a couple of our deals recently, we partnered with Qualcomm Ventures. We've spoken quite a bit with Intel Capital, and we partner a lot with General Electric as well. And whenever we bring on other people into the syndicate or other companies, we want them to be value added to the entrepreneur. And so we tend to see ourselves as a prosthetic extension of the management team when we invest in a company. You know, we want to help you. We want to help you by never telling you how to run your company ever, but helping you with customer introductions. And so by partnering with large strategics, you might be able to meet with their chief technology officer or some of the salespeople at their firm that can sell your product into their distribution channel. And so the bottom line is, as long as the strategic firm is additive and helps the underlying entrepreneur or management team or founders of the company, we view that favorably.
So I am from a strategic corporate venture fund, and I think, you know, the value add that we provide, being from South Korea, is that we can open up the door to the South Korean market for a lot of companies. But there are other ways that strategics can add value. For example, Flextronics, a big, you know, manufacturing company. A lot of, you know, they invest in venture deals, and the way that they invest is often by providing in-kind services, in-kind manufacturing services for their companies. So there are, with those types of deals, you can have different investment models that could really sweeten the pot for you, depending on what sort of company you are, of course.
So I think whenever you are raising funds for your startup, well, the theory is simple. Try to fund as much as you can by yourself, bootstrap, which is also a sign of the skin in the game. You are putting in your own venture. That's very important. Secondly, customers are key, even from a funding perspective. So before turning into venture capital and other investors for your company, if you are in a relationship with customers, your customers could be like the best source of financing, either by the commercial transactional relationship you have with them, like they can lend you money, or even as investors, kind of a small acqui-hire process, which sometimes works very well. You need to deal with that carefully because there may be limitations or constraints associated to the transactional relationship that may limit the growth of your company elsewhere. But if you are smart and you can play around those dynamics and you get your customers, especially they are big corporates, like invest in your company, that's the best setup possible. With that, you can trigger other investors, less strategic, into the pool and then complete your funding round initially. So that's the ideal setup. In the absence of that, you can look into crowdfunding and other sources, but then your investors are different. They probably are far away from you, they cannot understand the struggles you are having and how hard it is to really ramp up a company. It still works, but that, in my mind, should be like a second source of funding. Again, because they may be, whoever, in a crowdfunding environment, really far away from you. They may think only financially, and they may not be able of having empathy with everything that is happening with your company.
Thanks. Again, I guess I'm the last person on the panel, so I usually tend to agree with the guys who just speak before me. I think it's real critical to not just look for any kind of money. You really want to be able to align yourself with the so-called smart money, somebody who invests in your company and be able to add some value. on different in different perspectives, such as business development, sales, financial approach as well. So we invested in companies that we think that we can actually add value in all those areas, and that we can understand and look for their end users. Thanks.
Great. I've got one more question, and if we have time, I'll open up questions from the audience. But if you guys had any last-minute words of wisdom or advice for the audience, if you could just share what those would be.
Whenever I meet with a CEO or a founder of a company, I want to make sure that she or he is extraordinarily passionate about what they're doing. And if they can't sell me on the company or the product and don't get me very excited about it, then we tend to think that they might not be able to sell to customers as well. So just come across as incredibly passionate as you can, to the extent that you don't have a job, you have a passion, and you love what you do, because it will definitely show up through your enthusiasm and help you to close deals. Thanks.
I think we talked about the why earlier. That's a function of why you started the company, going back to the passion, going back to the insight, critical. I'd say at this point, don't be shy about asking for money. Get as much as you can now to set yourself up, not for the next 5 months, but for the next 18 months. And I would give you that advice because it's just a lot of uncertainty. Get as much as you can now, and if you have to sacrifice a little on valuation or whatever it is, go for it now and get as much as you can.
Know your customers, really know your customers. That means that you make a list for yourself. Every week you say, I'm going to identify 10 people for whom I haven't spoken with. Not to yourselves and not to friends and family, but you're looking for opposition, you're looking for people who are going to challenge you on what your product is or what your technology is, and make sure you understand what problem you're trying to really solve. So really know your customers.
I'll give two specific things that I've seen. I think number one, buzzwords like IoT and machine learning and big data. It's just, for me, I've heard them so many times that you have to provide substance besides that. And then number two is, so if you bring along a few people in a meeting, 3 or 4, maybe just 2 people, you guys should all be talking. Otherwise, it's kind of weird if one's just silent the whole time. So just FYI.
That's good advice. Sometimes in those meetings, it's more important what is not said than the actual talking happening. Okay. So advice is difficult if not knowing the specifics around every company. But I believe that 2 things here. I couldn't agree more with the customer approach, to the point that if you have even your employees or yourself sitting with your customer, even much better. So the level of understanding of the customer now these days has to be really intimate. And I've seen that happening, reaching an agreement, first customer, I have only 2 employees, can I sit them with you, Mr. Customer, so I can deliver on my promise better than anyone else. And that's sort of a proof point that you really are ahead of everyone else, doing that. So that's kind of the things that anyone investing will look in terms of whenever a company or opportunity is pitched. So that's one. The other one is if you are tempted to build your company as a lifestyle company, if you are familiar with the concept, that means that the founders are building the company to support their lifestyle rather than in order to build a company. That's a serious red flag that we always identify very, very early on. It's very easy to spot that one. Just a couple of questions around what the founder is intending to do, and if you detect that it's more a lifestyle than a future company, again, coming back to the point about the founder's trap and what are the temptations in the road, then it's not what we call a fundable company. So bear that in mind.
Thanks. 2 things I just wanted to mention. One is make sure that the investors understand that your product or service has been validated in the market, and also make sure that you have very strong financial projections, so that you understand the money part, that the investors understand that you understand the money part, and also how they're actually going to make money.
Okay, great. So we'll take some questions from the audience. Yep.
Well, from a founder's point of view, I think all of us are looking for money. We're looking for, it's a both-way road, right? So we're looking for money that doesn't just have a dollar amount, but for the brains that come with that money. That matters so much to us because it could determine the future of the company. With that notion in mind, one thing that I've been really trying to wrap my head around is the fact that the valuations are kind of flaky and they're talking about some kind of a bubble or whatever it's being called. My understanding was at some point that some of these companies that quote unquote safer investments for the investors who don't want to risk so much as they want founders to be successful like this before have been made on companies that had more of a short-term goal, like some attractions like photo sharing or a lot of other kinds of concepts could be exciting at some point. So it goes up and then down, and to me that's not a very long-term positioning for investors. Versus if you have a vision and it's a long-term vision that can grow and it can disrupt various industries versus just a group of people, it can't really go down that fast. And that to me kind of seemed like the sort of companies that are not having very fixated valuations, that are kind of going up and down. I want to know your understanding and your thoughts behind those companies that are not being as stable, like maybe those that you would be more careful about investing in. Would you guys say it's the vision that should be more focused on in the future of the company, or is there other things that we're missing out? Thank you.
So I would say don't ever underestimate articulating the size of the total addressable market that your company participates in. There are some venture capital firms, I won't name them, that will never invest in a company that doesn't have a TAM or total addressable market of at least $20 billion. And the rationale there is they look for the underlying company they're investing in to get 5% market share longer term or $1 billion worth of top line. So make sure it's a massive, massive market. Now, when I used to work in the public markets years ago, I would not invest in a company unless I could answer this question, which is this. In 5 years, is this company going to be more relevant or less relevant than it is today? And so in the private markets, of course, we look even longer term. You know, in 5 or 10 years, is this company going to be much more relevant than it is today? And so for me, it's difficult with messaging apps, for example. I don't know what the messaging app du jour is going to be in a couple of years. It's like predicting fashion trends, right? So we look for companies that are going to disrupt massive total addressable markets, kind of like Airbnb has done or Uber has done. And of course, the most important thing for us, though, as I mentioned before, is management team. You know, are we comfortable backing somebody that is going to be able to pivot and change if their end markets change as well, which they always do.
Yeah, and some of those amazing companies, by the way, are first-time founders because
Yeah.
they're so raw that they're risk takers. Just keep that in mind.
Yeah, you don't know any better.
Yeah. And we love those who see that. So, thank you.
Last one comment.
Any other questions?
Again, like,
Do you have questions?
I mean, I guess I need a mic.
You don't know. It's up to you.
Yeah, again, my question goes back to this capital-intensive investments, right? Like, you know, Tesla is a kind of an oddball out, like in recent times. That happened kind of like because Elon Musk was in a position to kind of invest $100 billion of his own money. Like, you know, that's where like a lot of the VCs, you know, talking about semiconductors or transportation sector, which can be capital-intensive, gets awkward, like because almost everybody in the VC is looking for, you know, a certain process of kind of building a company, like which is essentially like, you know, pivot, get some traction, build a small product, and kind of, you know, that kind of process may not work in certain industries. It's been a while since we've seen Qualcomm happen or Intel happen again. You know what I mean? That's semiconductors. Like when we are talking about transportation, which needs a whole system, like, you know, it takes a lot more than even a semiconductor company. Like, so, I mean, are there VCs like kind of looking at, you know, this kind of open-minded approach to, you know, capital-intensive industries like this, like which need a different mindset than just the internet-based companies?
So from my perspective, what's different about this cycle versus previous ones is you have this quintessential new cheap platform with Amazon Web Services. So just to put it into context, Microsoft, which is dominant operating system platform for 30 years before AWS was invented, Microsoft only cut the pricing point on Windows 3 times since the 80s. AWS has cut the pricing point more than 15 times, right? And so because AWS is so efficient and the barriers to entry are quite low for software and internet companies now, it is very easy to scale a software company. Compare and contrast that to a semiconductor company.
Yeah, but
which is
AWS
difficult,
happened like
or
because
hardware
of
companies even.
breakthroughs in virtualization, like people were kind of ready to kind of disrupt the operating system's business completely.
Right.
Like so,
Yeah.
but that kind of gets overlooked. Like a lot of times, like it's only the
Yeah.
the things that kind of run on
Well, I would say
AWS
that-
that people get attention on.
No, I understand, but I would say that Airbnb and Uber and all these great companies would not exist if it weren't for AWS,
Sure.
right? And so we've all been burned in the past on investing in hardware companies, a lot of them through clean tech. You'll notice a lot of VC firms don't touch clean tech anymore because of that. So that's just my 2 cents.
Thanks, Chris, that's a great point. I think you need to do your homework because, you know, I could use a specific example. We invested in a disruptive manufacturing play. We've had a recent discussion with the founder around now going to the next level. Now, this is a complete, you know, disruption play. That's an overused word, but what he's doing, no one has thought about it because he started doing this when he was 4 years old. I mean, literally, that's how far he goes back into building robots, right? But my point is, we had a very specific conversation about understanding he's not going to spend his time on Sand Hill Road. And if he is, it's going to be with 1 or 2 that understand manufacturing. So it's a function, if that's what you're doing, or transportation, that you do your homework. Because you have to have a receptive audience. And I think that really is a function of narrowing that down and using a network to help you do that. If that helps.
Yeah, I'm trying to do that myself.
Yeah.
That's part of the question. I guess.
Yeah.
So, I just wanted to answer your question because, since I'm a strategic, right, so our imperative by the mothership of, you know, the headquarters in South Korea is to invest in core tech companies. So my advice for, you know, people like you who really seek capitally intensive, you know, investments, check out the strategics who are willing to take that risk and see if you can make relationships with their headquarters. Once headquarters pushes it down to the investments, and then the investors are kind of strong-armed to make that. So that's just fun, kind of like funny thing you can do.
You got a question? Last one.
I heard George saying that we shouldn't be focusing too much on expensive marketing people early on, but then I also heard you all saying the importance of a really strong team, and how do we, where's the sweet spot where
Yeah, that's a
your
great
team is strong enough but you're not showing like excess?
Yeah, let me just quickly, so there are 2 things. If the great marketing person's a founder, please, sign up. What I'm saying is I've seen a lot of expensive people hired at a critical stage where we all know what we know, we don't know what we don't know. What I'm saying is leveraging infrastructure and a very distinct strategy, you can learn rapidly what's working or not, rather than seeing a ramp up, literally in a matter of 30 to 60 days, using the right strategies, right, and execution and technologies today, we could rapidly A/B test. And what I'm saying is have that ahead of hiring more expensive people because of the ramp up time. You've got 2 months of hiring, you've got 3 months of ramp up time, and then you have execution. And what I'm saying is the technology today is here to do that in advance or in parallel with hiring people. Does that make sense? Does that answer your question?
So then who are the crucial people to have on that team?
In terms of the founding team?
The initial team.
Oh yeah, it's for us, it's real simple. A technology person, very deep, and a business person. That could be anybody from, you know, sales, marketing, product. Does that answer your question? Okay.
Great, thank you. Let's give a round of applause to our speakers.